I will tell you, strictly from a mathematical and logical perspective, I don't think there's a better play out there whereby you can increase the amount of gold you ultimately end up with without spending any money. And in my opinion, really without, in fact, maybe even decreasing your risk, because the downside risk of silver priced at 22, 23 bucks an ounce to me is completely negligible. And the one or two times that we've seen the markets in the last decade act irrationally, like we saw in 2020, where silver went down to 12 bucks, you'll remember, Dunnigan, you couldn't find a thing on the planet for, at least double that make-believe melt price, make-believe spot price. So yes, I still believe it. Yes, I still think it's as good of a deal as it ever was, or as smart of a deal, to the point where I will publicly say I think it is the trade or the opportunity of a generation, certainly of the decade. And I guess we'll have to see where the chips fall. But no, I haven't been thrown off that trade one bit.
Today's discussion centers around a captivating opportunity explored through a mathematical and logical lens with Andy Schectman. He introduces a thought-provoking viewpoint on utilizing silver to boost gold holdings without extra costs, drawing upon historical anomalies and market dynamics. Schectman articulates a convincing argument for what he labels as the trade of a generation. Andy Schectman reportedly stated, there's this old saying that markets can remain irrational longer than you can remain solvent. And when you look at the ratio where we're sitting at over 80-1, it's just irrational. It's an anomaly in every sense of the word, historically and geologically. Let me tell you a story from back in 2010. I was doing my first podcast, and I reached out to my friend Bix Weir. I told him, Bix, right now it's 85-1. That's only the second time in human history, going back 5,000 years, that it's ever happened. This is unprecedented. We should be advising people to sell their gold and buy silver. And that's exactly what we did. I called all my clients and encouraged them to make the switch. And within 8 months, by mid-2011, silver was at $50 and gold was at $1,915, making it a 37-1 ratio. Anyone who followed our advice would have made over 2.25 times what they started with. It's a perfect example of how ratios and mathematics can work in our favor. But remember, markets can stay irrational longer than we can stay solvent. However, this anomaly in the gold-silver ratio remains strong both historically and geologically. This calculated speculation is what I believe to be the trade of a generation. He expressed surprise at the current situation, stating that he doesn't take his statement lightly. He referenced Rick's analysis, highlighting gold's historical leadership in previous bull cycles and its continuation in the current cycle. Schectman suggested that silver tends to outperform gold once it catches up in percentage gain, emphasizing its potential to surpass gold's performance. Schectman noted various metrics indicating silver's growing demand, despite holding the largest concentrated short position on any commodity traded on the exchange, which suggests potential manipulation. He emphasized silver's increasing usage in green initiatives, digital technologies, and military applications, along with its minimal recycling due to its small usage in electronic devices and industrial applications. Additionally, Schectman discussed the historical significance of the gold-silver ratio, emphasizing silver's undervaluation relative to gold and recounting past scenarios where exploiting this ratio led to significant gains within a short time frame. He highlighted silver's long-term potential, driven by increasing demand and diminishing supply, as well as its diverse applications across industries. Schectman acknowledged potential risks, but expressed confidence in the strategy's soundness, providing a strategic perspective on capitalizing on the current market opportunity. Throughout history, there has typically been a consistent 16-1 ratio of gold to silver. However, recent observations from individuals like Keith Neumeyer, CEO of a major silver mining company, indicate a shift. Neumeyer suggests that the ratio is now closer to 7-1, highlighting the depletion of silver as an asset both above and below ground, coupled with its increasing utilization across various industries. Schectman finds it somewhat surprising that the ratio has remained stagnant for as long as it has. Nevertheless, he remains confident in the calculated speculation surrounding silver, viewing it as a low-risk opportunity with the potential to increase one's gold holdings without additional expenditure. Despite acknowledging the possibility of unforeseen events, such as gold becoming exceedingly rare, Schectman maintains his belief in the mathematical and logical soundness of the strategy. Reflecting on recent market fluctuations, including the 2020 downturn where silver briefly dropped to $12, Schectman remains steadfast in his conviction. He believes that even during such market irrationality, the inherent value of silver persists. Schectman asserts that the current situation presents a unique opportunity, one he considers to be the trade or the opportunity of a generation, if not the decade. Schectman also comments on investment behaviors, contrasting the methodical approach of entities like the BRICS with the sometimes unrealistic expectations prevalent in the United States. He notes the tendency for individuals to delay action until the last minute, particularly evident during periods like the end-of-year rush to manage IRAS and transfers, which adds unnecessary stress to the system. The essence of the matter lies in conducting transactions with physical assets in the correct manner. When engaging with a storage facility that segregates assets, it entails more than merely receiving the items sent to the depository. It involves thorough inspection to ensure that the contents align with expectations, followed by accurate cataloging and placement, along with the proper documentation to match received items with certificates. It's essential to recognize the distinction between handling physical metals and digital assets. Unlike the instantaneous nature of digital transactions, dealing with physical assets requires patience and careful consideration. Considering the multitude of clients these facilities cater to, including large institutions and banks with substantial accounts and era constituencies, transactions may take longer, especially with facilities that employ segregation methods. In summary, Schectman emphasizes the necessity of a methodical approach in seizing the current opportunity. Realistic expectations and patience are paramount, particularly in transactions involving physical assets. He advises viewers to grasp the nuances between physical and digital asset management, stressing diligence and allowing sufficient time for transactions. By partnering with reputable storage facilities and adhering to established protocols, investors can effectively navigate this unique opportunity. Schectman's insights provide a strategic outlook on leveraging silver to enhance gold holdings, presenting a compelling narrative for prudent investment decisions in today's dynamic market environment.